Welcome to the Growth Whispers podcast, where everything we talk about is about building enduring, great companies. These aren't flash in the pan companies. These are companies that do amazing work, create amazing value for their customers for decades, generations, for years and years and years to come. And that's what we're passionate about. I'm Kevin Lawrence. I'm here with my partner, Brad Giles. Brad, how you doing today?
Very good. Very good. It's so nice to be having a break. It's so nice to, just be winding down after the calamity that was 2020 and just, slowing down a little bit, catching your breath, recovering, all the things that we that felt so far away in 2020. It's awesome.
It is. Yeah, and as you were talking about 2020, I'm thinking, but 2021 is already where my brain is at. And we're recording this in 2020, but you'll be listening to it in 2021. So yeah, it's exciting to make it through this year and see some of the major innovations that have happened, the lessons that have happened, and a reminder of how we can adapt to almost anything. And wow, did we adapt? So hey, so what are we digging into and talking about today, Brad?
Yeah, so we're part 4 of 4. So we've done 3 previous parts each of the last 3 weeks. So this is part 4 of 4. And what
Pot
we're
four. What's a
part,
pot? Is it
part
like a
is
pat on the back, or it's a
it's a
pot?
component of many parts, a component of many sections.
Ah,
Yeah. So
okay,
we've done
like piece of.
a piece of yeah. So we're doing this is the 4th piece
Yep.
of
Okay.
4 pieces where we've previously spoken about the people and the strategy and the execution that you need to focus on heading into 2021. And now we're focusing on cash and the balance sheet. So, what do you need to do on cash and the balance sheet heading into 2021, given all of the calamity that was 2020, given so many major changes that we've been through?
Awesome. So specifically, we're going to kind of dig into 2 parts today. Number 1 is about consistent profit generation and growth. Lots of people get excited about growing their top line and revenue growth, and I think it's a wee bit dangerous to look at business that way. It's interesting, it can make you feel good, but true growth of profit and generating more profit and subsequently cash is some of the most important and I think ideal measures of growth. So we're going to talk about that. The second part we're going to get is on that balance sheet. What do you got to do to build a big, fat, rock solid, bulletproof balance sheet so you can weather any kinds of storms or viruses that come along, so that you can find ways to pivot and change your path and change your approach, so that you can continue to endure, even if things get a little bit weird and a little bit messy for a while.
To weather the storms, because the perfect example about weathering the storms was what happened in early 2020. We know that, but I'm not saying that there will or will not be another storm immediately, but we've always got to be prepared. We've got to endure. Like, the objective
Yeah.
broadly is to endure. The person who doesn't make it to the end of the race doesn't endure to even finish. I mean, you've got to be able to get through it, and that's the essence of the of building the balance sheet and taking a moment in January to say, okay, how can we strengthen our balance sheet in 2021?
Yeah, and as you're saying, you don't know when there will be another storm, but there always is. There's always
Yes.
something else that happens. Things are continuously, get weird, and events happen around the world, economic events, social events, whatever it happens to be. And we just need to be prepared so that we can handle those things. And in a big fat balance sheet gives you options. Cash always gives you options. It's funny, I was talking over the weekend. We're doing there's a group of us that invest in some real estate developments through some guys we know that run a great development company. And there's another project coming up, so we got all of our kids on board so our kids could learn about real estate development and investing. So we had a hour and a half session. It was just awesome last week. And as we're going into it, and these guys who have done amazing developments all around North America were on there teaching the kids, and they're saying, The thing about real estate and real estate investing and development is you only ever lose money if you're forced to sell,
Hmm.
especially if you're investing in markets that are growing. If you're in a small mining town, and that mining, that type of mining gets banned by the government, or the mines dry up and there's no demand anymore, that's a different situation. But in a major market like we live in Vancouver, or your major cities like Sydney or London or other major cities, yeah, that you only lose money when you're forced to sell. Your biggest problem penalty is time and to wait, but you can only afford the luxury of time if you have enough equity in your investment, or enough cash to fund it, to bridge the extra time.
Yeah.
And that's why cash and balance sheet is so important. And business is the same, is that you only truly lose your business if you run out of time. If you can wait and wait for a better market or better opportunities, or your team to create better innovation, you're fine. But running out of time is the piece that really gets people. Running out of time, running out of cash.
Yeah.
So why don't we drop into ensuring that that you endure, and that kind of thinking. And one of the things we want to share today is that if you look at the most successful companies we work with that are enduring great companies, although they want immediate returns and they're looking for quick returns if they can, but they think about a lot of things on at least a 10-year investment horizon, at least, because they're investing and building for the future and thinking beyond the market cycle that we might be in at this point. So for example, people that are really thinking, they're investing today in whatever their business is or market is, and they're thinking about the little bit of a mini boom that we're having, depending on your market, but lots of markets are booming. They're seeing that there will be an adjustment at some point, and then there's going to be another boom. But many of them are investing towards the next boom and not getting too caught up in the short term, if they have those great big balance sheets.
Yeah, it's interesting from a personal perspective. As an example, if you were going to buy a house to live in, if you can say, would I still want to live in this house in 10 years? Now, we may not all be blessed with the ability to do that, but if you could, that's the type of thinking. If you were to buy a car, would I still want to own this car in 10 years? If you were then going to apply it to your business. If I was going to employ a staff member, would I want to employ them still in 10 years? If I was going to buy this office or open this new office or whatever it might be, can you apply this 10-year thinking rule to your cash decisions rather than having no time frame? So it's not that the opposite would be short term, it's that people don't even apply any kind of time frame around it. They don't even think about it. So just beginning to say, if I would I still want to do this in 10 years time?
Yeah, it also gives you a sense of the confidence you have in your business, your strategy, and your team.
Yeah.
Because if you're not willing to make investments on a 10-year time, right now, maybe you plan to no longer be the owner of the business or the leader. That's a different situation. But if you plan to still have the business, that you still own it, or it's in your family or in your portfolio, would you still make those longer term investments and at least think long term? And when Brad and I we were talking earlier in the show, there's a great author and CEO, Jack Stack. He's got
Mm.
a program he teaches called The Great Game of Business. And is SRC Capital, Brad, is the company, is that right?
Yeah, Springfield Remanufacturing Corporation
Corporate.
is
Yeah.
that was the original, but they've spun out about 60 different businesses from that of substance, like serious businesses.
Yes. And their philosophy is teaching everybody in the company all the numbers in the business, how to budget, how to forecast on a weekly basis, so that they can really be tuned into the work they're doing and how it contributes to the company's success. So basically, everyone is trained to think like an owner, and it's not just propaganda. It's really true in the business. And yeah, and many people in the company have grown up and went and started off other businesses, which the group has funded, and they built a great empire. But one of the things that Jack talks about, and I remember in a session I was in, he was explaining, I was chatting with him about this. He's saying that they spend a lot of time trying to predict, like, economically, trying to have their belief about what the market's going to be in the next couple of years. They use a lot of forecasting around the markets, the economy, and they have a lot of indicators that they follow. And Brad, we're talking about this, is they talk about whether they're an up phase or a down phase, and they kind of have their own forecast they work with, or predictions they work with, and then they know in different phases they're actually in different modes of whether it's investing or conserving cash.
Yeah, I remember seeing him as well. It's a fantastic example of long-term thinking applied to today's priorities. And so what they're doing is they're saying, if we're in the accumulation cash phase, it would be generally when the economy is in an up phase. And then they accumulate that cash during the upturn. And then when the economy turns down, they're buying assets at a bargain basement price. And I remember he gave the example that they were buying land, and I think it was at $100 a square foot, where it was like $400 or $500 a square foot, and it might have been industrial land. It was $400 or five
It
hundred
was, yeah.
dollars a square foot previously in the up phase. And that meant they were able to come in and buy it at bargain and basement price, and then grow from there. By the time they got to the next up phase, it went up to $400 or $500 per square foot again. So how can you think like that? How can you begin to think, well, given your geography or whatever it is, what phase of the market are we in? And should you be in an accumulation phase for when the market goes down? Or alternatively, if you're in a down market, do you have the cash to capitalize on that?
Yeah, so let's start with our kind of cash principles, because the first thing is to accumulate the cash so you have the opportunity to. And the ultimate measure of a business is consistent profit generation and growth on that. That is ideally growing that profit generation, which ideally is cash generation. So there's kind of three key things, but the first thing is we want to look at is it's the discipline of profit. And most businesses have it when they start, not all, but most. But it's the profit discipline and analyzing every decision based on its contribution to profit, not revenue, not necessarily even gross margin. That is a very great place to look. We have another podcast just on gross margin. Brad and I both love that number. It's a key driver, key indication of strategy, etc. But truly looking at the bottom line profit impact. And if we look at the most profitable companies that I've worked with, they pay a lot of attention to profit. Shocking. But I've had many who don't. Many who focus a lot on revenue growth or other measures that, and I want to be kind in how I say this, but many of those that are many ways vanity metrics. They're volume kind of metrics. They might make you feel good, but the idea of a business is to serve a greater purpose and generate profit so that, one, it can reward shareholders and the people in the business. Two, it's got the resources to continue to grow and make its impact in the world. So looking at as many decisions as you can through the filter of profit. And that's not easy. Your finance people might get a little bit frustrated because you have to get appropriate allocation of overheads, etc. And I never forget, as an example, I remember looking at one part of a company, and they had a whole piece of business that was very low gross margin. And on first blush, you'd say, yeah, this is low margin business. It's not worth it. But when you really dug into it, it did not consume almost any overhead at all. So let's just say the business ran at a 25% gross margin, normally had 15% overhead. So that would leave 10% to the bottom line. Well, this line of business had about a 15% overhead. And if you weren't overly sophisticated and looked at it, sorry, a 15% gross margin. If it had a 15% gross margin and there was a 15% overhead, you could fairly quickly deduct that business won't make any money. The overhead will consume all of the margin. But if you realize there's no labor, there's no almost executive time, there's almost no administrative time, because it was buying containers of product and directly shipping it to another country. They never touched it. They never paid for it. Like it didn't even touch their income statement in the way that they had the payment terms set up with the vendor. It was the vendor, so who they bought it from, would invoice directly and just give them some, basically essentially like a commission on it. Anyway, it's a little
Mhm.
bit complicated. The point of it is it was actually some of the most profitable business when you looked at it through the lens of profit,
Yeah.
but on first glance, it didn't look very good.
Well, that's the old statement. That's the old saying, isn't it? Revenue is vanity, profit is sanity, and cash is king. I mean, we all
Yes.
know that one, and that's really what we're saying here with this first one. Just think about the decisions that you're faced with going into 2021, and how many of those are about vanity, about volume metrics, because what really matters in this incredibly volatile world that we're living in at the moment, more than ever, perhaps, is the sanity of profit. So, how are these things really
Yes.
contributing to your profit? Take a moment to look at that. So then if we move on to number two, what we're talking about here is going a little bit deeper onto number one, perhaps, but perhaps formalizing that to another degree, which is to have investment criteria, just a simple set of investment criteria that you can work to. And that could be 3 to 5 things. So we're not going to invest in a person or a piece of equipment or machinery or plant or whatever it is. We're not going to invest unless it meets this criteria. And examples of the criteria could be what's going to be its impact on our profit per X. Is it going to positively impact our profit per X? Is it going to align with momentum on our flywheel? Uh, are we able to fire bullets before cannonballs to do a small trial before we go
Yeah.
in on a larger investment? Um, and then things like, how will it impact our cash reserves? A lot of those types of things. So, for the organization broadly, thinking about building a simple investment criteria that a discipline that you'll stick to.
Yeah, and although it sounds basic, it makes it easier to filter through some of the decisions that you probably don't want to waste any time looking at. And it kind of gives your team some marching orders, or kind of sets them on a hunting trip to look for the right kind, or hunt for the right kinds of ideas that would be worthwhile considering and having an impact on your business. Or, in some cases, if they're smaller than that, if it's going to cost $5,000 and pay for itself in 6 months, we don't even need to talk about it. Just, go do it. Do it within the
And
budget you have, or something like that.
and that's how I've used that previously with leadership teams is we want the different departments, divisions, etc., to be genuinely competing for capital
Yes,
with integrity, right? We want them to create meaningful business cases that all meet that criteria, and they know how to assess the investments that they're effectively asking for, be it people again or machinery or whatever it might be. So
correct.
building that and distributing that to the other leaders in the leadership team and their teams to work through.
Yeah, and ideally, you have more options you could invest in than you have the capital to invest in, or the appetite to invest in. So it
Yeah.
gives you choice. So, because there's always going to be mediocre ideas, good ideas, and great ideas, and then
Yeah.
amazing ideas. And you want to be able to have a process to choose from those, both to sometimes enhance the thinking of your people, and two, just to pick the best ones and drop the rest. So the final piece we have here is to leverage the power of this thing called cash conversion cycle for your reporting and your comparison or analyzing different decisions. And cash conversion cycle, in simple terms, now if you haven't dug into it, it is amazing. Not everyone reports on this, but it gives you a simple look at cash in terms of the number of days of cash that a key part of your business uses. And for example, um, inventory. Like if you have $10 million of inventory today, and you think that that's okay, but as your company grows, well, now that 10, a comparable number is 20. And sometimes people's brains don't adjust properly to the growth. Where if you look at inventory and saying, look, we have 37 days of inventory, and we know, and as the revenues grow, the 37 days would stay the same. And ideally, we drive it down to 10 days, 5 days, no days, if your model will allow it. The point of it is by looking at inventory, receivables, payables, or other things in a system in days, it helps you see the time. And it's the time value of money and the time that things are locked up in processes that really can hurt or help a business. And the idea of cash conversion cycle, it's from when you invest a dollar in something in the operations until it comes back through receivables into your bank account. How long does it take for you to turn a dollar in your system? It's the ultimate measure of cash efficiency of a business. It's amazing. And it forces a lot of mind blowing thinking. There's an article called How Fast Can Your Company Afford to Grow? And the authors, the names will come back to me in a minute. But they came up with this model. You got the name there, Brad?
I'm thinking Churchill.
It is
Um,
Neil Churchill.
yeah.
Neil Churchill. How fast can your company afford to grow? I believe it's a Harvard Business Review article. It is outstanding. I've gone into companies that have been in business 20, 30, 40 years, and then the founder's eyes open a mile wide and go, if I had had this 30 years ago, I wouldn't have had the financial troubles I'd had. It is
So,
outstanding. And
yeah.
and it's a simple number that everyone can understand, and it's not all in accounting speak that confuses people.
Yeah, so it's like a relay race. You begin sales, there's a sales process. How many days does that take? Make production inventory process, how many days does that take? Delivery process, how many days does that take? And then the billing and payment process, how many days does that take? The objective is you add up all of those days, and that's your cash conversion cycle. We want to find all of the small tactics and activities that we can undertake to shrink that. If you can take 10 days, for example, off your cash conversion cycle, it could actually create a huge amount of cash. And that's what we're suggesting really heading into 2021. Just stop maybe with your leadership team and say, let's run the cash conversion cycle exercise. And what are the activities that we can do to take a few days off all of these components of that relay race?
And not only does it put more money in the account, it can allow you to grow at a faster rate without needing external capital. So it allows you, it's called SFG, self-funded growth, which is the ultimate form of growth. It's, I've seen companies that can go and you can do some calculations based on your existing, cash model and your cash conversion cycle. And I've seen companies that can grow at 9%. The fastest they could actually grow without choking on cash is 9% because of this. We go and shorten cash days by 30%. They can grow up to 100% a year if they want. It is magic. Because what companies don't know is that if you don't really understand cash, and most people don't have a clue, uh, everyone thinks about profit. Executives are not trained in the impact to cash. They might understand the balance sheet, but they usually don't take into account the relationship between the two.
Yeah.
So what you can do is grow your company so fast that you choke it and starve it and get yourself in a cash crunch. Anyway,
Mm.
it's outstanding stuff, understanding cash conversion cycle, making decisions through that lens. And we freed up hundreds, I think up to like $180 million cumulatively we freed up in companies with that tool. It is unbelievable. And at the end of the day, it takes money that's stuck in your business or stuck in the market and puts it back in your company for growth capital or other uses. So three things around cash. Consistent profit generation, is the driver here. Analyze decisions based on impact to bottom line. Revenue is vanity, profit is sanity. Pay attention to profit. And then have a set investment criteria because you're teaching your people how to think like business people and make good decisions. And then leverage cash conversion cycle. Leverage the tool to help you think about and get educated around cash because it can make a really, really, really big business. So let's switch from the profit ideally generates cash, although not always. And then it shows up and sits on the balance sheet. And there's, and that's the piece that we're going to dig into a bit here. And, having a strong balance sheet allows you to endure the storms and stay at choice of how you run your business. If you screw up your balance sheet and your banker starts to become your best friend, you don't have choice anymore. You can't do the things you want in your business unless your banker friend says yes. It's like they're standing over in the corner, watching over your shoulder, managing all of your decisions.
Yeah.
And, you know, in many cases you earn it because you're not in the most strong place to tell your banker to go take a hike. And and sometimes they can be helpful. I'm not saying bankers aren't bad. Bankers can be helpful. They can help you and support you in getting yourself back on track. They can be great partners. But the key is to have the balance sheet so that you can do the things that you want in 2021 and beyond.
Yeah. So the first thing that we've got here is building the ability to scale up or down without big costs or contracts. So having a mindset to protect the balance sheet, to strengthen the balance sheet because of the volatile nature. So, for example, can you hire people under contract or part-time contract or contract labor rather than full-time? Now, this doesn't take away from the enduring concept that you've got to build a team of A players. We always know that. But can you scale quickly? Can you be more agile by not committing as much as quickly? And really, the reason for this is so that if something happens, and things have happened, let's be fair, in 2020, we can then scale back down. We can then drop those fixed expenses as quickly as we need to. So a bit more relevant heading into 2021 than normal. And it could be also around investment. It could be, can you lease rather than buy through hire purchase? Is there any other areas where you can have a more agile balance sheet that you can then scale it back quickly?
Yeah, I like that, Brad. Agile balance sheet. And that's the idea. Not getting locked into a bunch of commitments where you have to have things go a certain way. Or if you do, just make sure that you have backup plans. And you have plan, A, B, C, and as Jim Collins would call it, a healthy degree of productive paranoia. But there's many times you can do deals or contracts on shorter terms. Like, one of our clients that had a big renewal on their office lease. They just did a 1-year extension. Now, I think it cost them 20 or 30% extra, but for them, it was worth that 20 or 30% to defer a decision for a year because they didn't know. They got a couple floors in the downtown of the city they're in. They didn't know. And for that extra amount that it cost them, it was worth it for them to basically buy the flexibility
Yeah.
versus locking into another 5 or 10 year lease, which they normally would have done in this case. So let's go to the second one. So we've got the ability to be the flexibility with your what was that word you said with the balance sheet? You said agile
Agile.
balance sheet. I just remember that one, Brad. That'll end up in the book. Agile balance sheet. I like that. So the next one is continue to build cash reserves. Collins would call them oxygen canisters. Some would call it war chest, available credit, or just a big freaking mountain of cash. But what is it? What is it you can do to build cash? And going back a couple shows, and I believe this is appropriately attributed to Warren Buffett. When people are greedy, be fearful. When people are fearful, be greedy. It's kind of hard. Right now there's a lot of fear and there's a lot of greed, both in the marketplace. But you know, having after the boom times that we're experiencing, and I'm telling you, like in our country, there most industries, not all, many are having incredible booms. Clients having record years, not counting the government's bonus cash or surplus cash or stimulus, not surplus, stimulus. But it's what are you doing to build your buffer so that you are ready for opportunities, whether it's buildings, businesses, people, whatever it is that can come up. And ideally, I'd recommend is setting your cash buffer target for 2021. I've always pushed clients to build balance sheet and to build cash because
Yeah.
then you can pounce on opportunities when they come up, and and be ready to go. So yeah, what's if you just think to June, whatever you're at in terms of cash, and whether you count it in days or dollars, what would you like that cash buffer to be, so that you've got all kinds of options? And it might be just a big dividend to the shareholders, which in great times is a great thing to do as well.
Well, gee, there's a lot of volatility out there. Look at the country level. I mean, certainly in Australia, we've got macroeconomic, um, I'm going to say trade tensions with major trading partners without
Hmm.
digging into that at all. And I know that's the same across many, many other countries. And, with the swipe of a pen, people can be significantly affected. So that's one thing. We've got a global pandemic. Okay. That's another. We've got a stock market in the US that's been rallying effectively for 10 years. Like we can reel off so many things that are challenging. And if you can take away the euphoria of the moment, if you're doing well, because some people are not doing well, um, cash can burn a hole in people's pockets. And that is probably primarily potentially driven by emotion. So if we can take that away, given everything that we know, even if you have got a good cash buffer at the moment, where is it going to be by June? And we say June because it's halfway through the year, right? And I
Yeah.
say June intuitively because that's the end of the Australian financial year. So it kind of takes me to that as a milestone. But where will you be by June? Where do you want your cash reserves to be? And then holding the line on that, because that cash buffer, for so many people that I work with, that's what gave them options in March and April. That's what gave them the ability, because we built it up over years. That's what gave them the ability to stop, to slow down, and think. When you're panicking, you can't make rational long-term decisions, and that's effectively what you get from a good, decent cash buffer. So, where is it going to be in June 2021? Set an amount and then work towards that, and then maintain the discipline and the constraint. So then we move to number 3, which is really coming from, I guess, primarily, where are your contracts? This is within your balance sheet again. Where are your contracts? Where is your debt? And we have an almost zero debt environment at the moment. So it could be the rent that you're paying with your landlord. It could be the debt that you've got with your bank. What can you do in January 2021 to look at how can you get better rates, better terms? How can you get access to more capital? People are often wanting to do deals right now. So just looking at a list of all of your contracts, how can we improve them? I mentioned to you earlier, Kevin, I remember many, many years ago, maybe 10 or 15 years ago, we had a server that we were paying for in my company under a hire purchase to buy contract. So you pay for it, let's say for, I don't know, 36 months or whatever, and then you own it. And my accountant at the time didn't have a registrar of when things were going to end. So we paid for that for 9 months afterwards. Clearly it cost and it burned me a little bit, and I haven't forgotten it. But we paid for it for about 9 months afterwards when we shouldn't have. And so that's what we're really saying. That's an extreme example perhaps, but maybe there's better interest rates, better terms. They're saying in Australia at the moment, all you've got to do is ring up your bank and say, can you give me a better rate? And they go, yes, okay. So yeah, just taking a moment to say, how can we improve some of the terms the contracts that we're in?
Yeah, and it's taken the time to look at them. Obviously, the rates are at historical lows in many, many countries. Most, probably, I would imagine most, but I know in many countries. So there's opportunities there. And I always remember a strategy one of my clients had around cash. They were a brilliant client, owned multiple companies. I remember one of the companies was wildly successful and making lots of cash and had lots of cash in the bank. And they were doing a new project and they went and borrowed the money. and rates weren't as good as they are today. And what they said is, look, at the end of the day, we want to hold on to our cash. Cash gives us opportunities. It's for them, it was opportunity money because there were certain businesses they wanted to acquire, and having enough cash to do the deal tomorrow was a benefit to them. So they would have, X hundred of thousands or millions of X millions of dollars in the bank, but then they would go borrow amount of that. So they always still had their cash to move quickly with, which was really interesting. And so everyone's got their own strategies. Leveraging, the bank and leveraging other people's cash is a great strategy for lots of business as long as you don't do too much. But how do you do that most economically? Another one of our clients right now has been negotiating with their banks over the last while. And you just tell me the deal they got, and they're going to switch banks. Not only are they getting better rates, which you could potentially negotiate with your existing bank, but they're getting way more flexibility. They're getting a bigger line of credit for operations, and they're getting access to another pool of capital for acquisitions because the company wants to continue to grow. So they've got themselves a great partner. And remember, the banks are always looking for people to lend money. That's how they make money, right?
Mhm.
That's their economic model. And they're always looking for new people. They're always looking to expand their book of business. Now, depending on your industry segment, they might be more or less interested in you, but it's a great time to evaluate that. Some companies, might take their extra cash and pay down their debt and just sit with a no debt on their balance sheet. And there's lots of people who would argue against that, you know. But the point of it is, whatever is right for you, it's time to look at it and put yourself in a better position. And ideally, if you can, get some cheaper cash, cheaper money.
And so there are the things that we're saying heading into 2021. Let's do a super quick review. Um,
Mm-hmm.
to begin this is born, these 4 episodes are born from our episode 31, which was what are the things that you need to do broadly to build an enduring great company. And we built 8 things out of that. So the first that we've got today, cash. So what do you need to do to have consistent profit generation and growth heading into 2021? Analyze all decisions based on impact to the bottom line. Number 2, have investment criteria. Build a list, 3 to 5 things that you can get your teams to compete against one another for capital on. Number 3, um, analyze your cash conversion cycle. The 4 elements: sales, make, production, inventory, delivery, and billing and payments. And how can you reduce those days? Then we move on to strengthening your balance sheet heading into 2021 so that you can endure the biggest storms and stay focused. So first of all, build the ability to scale up or down. So try to make your decisions based around the ability to cut off those costs very quickly if you need to. Build your cash reserves. Set amount of money that you want to have in the bank as cash reserves June 2021. And then number 3 on the balance sheet is looking at your debt and looking at your contracts and your leases and all of those things and saying, how can we improve these terms, if at all? And just taking a moment in January to look through those things. So that brings us to the end. What a good chat we've had through these 4
Mm-hmm.
episodes. Good to dig in and hopefully provide some ideas for people to renew heading into 2021 the different areas within their business. So thanks for listening, everyone. This has been the the Growth Whisperers podcast. You know what I'm trying to say, with Brad and Kevin. I'm Brad and he's Kevin. For the video version, you can go to YouTube and search The Growth Whisperers. For me, Brad, you can find me at evolutionpartners.com.au. And for Kevin, you can find him at lawrenceandco.com. Thanks, everyone. I hope you have a great week. Thanks for listening and speak to you next week.